Hello and welcome to Portfolio Matters, and today we will be talking about the small UK gas producer Independent Oil and Gas. Before we do that, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Tell us about independent oil and gas, Keith.
I should warn you, this is going to be unsatisfactory. We're going to try and push through this quite quickly because, frankly, I haven't been able to make any firm conclusions about it. So this is mainly going to be a description of the company. The bottom line is it is a gas producer with assets in the southern North Sea, and it's fully funded. It's got the pipelines and the installations being refurbished now, and it's all set for first gas in Q3 this year. But the reality is it's impossible to value. It's got no revenues, and I've struggled. Eventually, we have to rely on the tame broker's valuation, which is very unsatisfactory. We will know more about the company when it has real revenues next year. So this is a share price which is going nowhere and is currently about 16.5p. Market cap of 81 million. It's got debt, and the estimated revenue this year is 21 million, bearing in mind that it's only getting revenues from Q3 onwards. Now, it has a partnership with Cal Energy, which is a subsidiary of Berkshire Hathaway, and it has farmed out its fields in the North Sea to Berkshire Hathaway, who have taken 50% in exchange for development funds. As I said, first gas is Q3 this year, and it's very difficult to value. Right, so what is it? Its name is oil and gas, independent oil and gas, but it's not. It's gas. And its main assets are in the southern North Sea, although it does have exploration assets elsewhere, including west of Shetland. Now, it's forecasting peak average gross production of 140 million cubic feet, and we will go into that. Now, one of the things that it says in its investor presentations is that the UK is running out of gas, or is running out of domestic gas from the North Sea, and that is absolutely true. But the implication of that is that gas prices should rise, and I don't think they will. So this is from Ofgem, and this is the UK natural gas market. And the UK probably has the most flexible natural gas market in the world. So we have a Belgian interconnector and a Dutch interconnector and a Northern Ireland interconnector, although the Northern Ireland interconnector exports gas from this country to Northern Ireland. So I'm not sure there's much re-importation from it. But there are several things you can take away from this chart. That A, we can import gas from multiple sources to supply the market. And also, over the course of the last 10 years, I think you could say there's a distinct downward trend in our gas consumption. And one of the things we have talked about previously, and in particular when we did a share talk on Drax, is how the increase in renewable energy in the UK, so wind farms and solar, is leading to the undermining of base power prices in the summer in particular, and that causes gas prices, gas consumption to go down. Basically, the baseload gas power stations are needed less often, which means they need less gas. And so these are electricity prices. And you can see during the summer, electricity prices collapse because you're getting electricity from wind farms and solar at zero marginal cost. And so there have been times when the electricity price has gone negative. one potential upside for gas prices could be the rising oil price. Now, this chart shows that there is a correlation between gas prices and oil prices, but gas prices are much less volatile. So you see here, when oil prices collapse, gas prices collapsed as well, but not as much. And hence they're not recovering as strongly. And in 2017, when oil prices increased very quickly, gas prices really didn't move much at all. So I don't think you can say that gas prices are going to shoot up because the oil price is shooting up. However, you will be aware that there was an enormous spike in the price of liquid natural gas in Asia this winter, which is an indicator of a lack of flexibility in supply, and there has been market commentary about how there may be structural undersupply due to years of underinvestment. We will see. I'm unconvinced that this would affect the UK because we have very flexible sources from Norway in particular, but also from Dutch gas fields. And despite the spike in LNG prices this winter in Asia, Citigroup are actually forecasting the all year round price for 2021 to be $5.5, which is on average. So I don't think there's much evidence of a systematic increase in the gas price. These are their gas fields. So this is the Bacton terminal on the coast of Norfolk and the Thames reception facilities there. Now, those were existing and they've just had to refurbish them. And the same with the Thames pipeline. So this has been a relatively cheap development because they haven't had to build new infrastructure. And the fields in dark blue are the ones which they are developing and which will come online soon. The ones in turquoise are ones that they have and are awaiting development and are due to come online in later years. Now, you will notice that several of these are not shown on the map, which I found puzzling. Nailsworth and Elland. So I had a look on the Cal Energy website. Bear in mind, Cal Energy are the Berkshire Hathaway subsidiary who own 50% of all these fields. And here they are, Nailsworth and Elland. They're right next to the Vulcan field. And if we go back here, this is Vulcan. And you'll notice how close some of these discoveries are together. Elland is here, Nailsworth's here, Panther is here, and the Vulcan Satellites have a hub there. So, they are searching around for gas fields that have been left behind, and they are small because this is an old field. So these three highlighted fields, Vampire, Viscount, and Vulcan, were closed down by Conoco in 1998. So they were developed in the late 70s and 80s and had reached the end of their working life by 1998. So this is a field reservoir that has been picked over extensively. But they are finding these small fields. But you have to think any discoveries they make are going to be small, or they're going to be ones that were found before but were uneconomic. And this is the development profile. So you can see this year they've got Southwark, Blythe, and Elwood coming online. 2022, they're firing on all cylinders. But look how quickly production declines. Production from those fields really collapses in year 2. I mean, that is, I'd say, less than half. And then you need Goddard and Nailsworth to come online to keep production up. And then they decline quite quickly, and you need Elland. So essentially, in order for this to keep up ongoing production, you have to believe that they're going to keep on finding new discoveries. And they're describing the company as well placed for the energy transition and net zero. Well, they make gas. So I'm skeptical. And, they make this big thing about how there are solid fundamentals. But as we can see, actually, the UK gas market is very well supplied by these interconnectors with Belgium and Norway and LNG. And also, there's a structural decline in UK gas demand, which is likely to accelerate as we get more renewables into the energy mix. So I'm deeply skeptical about this. Results, and you can see they've been going a while. They've never had any income. They have made profits, and the profits are when they're farmed out. So when they farmed out to Berkshire Hathaway, Berkshire Hathaway pay them, and so they've made profits but no revenues. But their forecasts have first revenues this year. Now, I found this impossible to value, and so the valuations that have been done are based on reserves, and the reserves are here. Total reserves of 151 billion cubic feet before adding in the other prospects. So they do have other prospects. So Peel Hunt are valuing the shares at 41.3p. And bear in mind, the current share price is 16.5p. Total reserves, 152 billion cubic feet. Now, I have had an attempt at valuing the company, and frankly, I think this is pretty worthless, but we will go through it anyway. So 152 billion cubic feet, and let's assume that the price of gas will be 44p, 43.75p per therm. That gives total gross revenues over the life of these fields of 665 million. And what's the margin? I mean, I'm guessing 30%, 200 million. That's like 33p a share. And then you'd have to discount that over time. You get to, I don't know, I've got no idea. Well, you're 20p a share. I've got no idea. So the reality is I've had an attempt to value this company and have failed. So we'll have to see what happens when it has revenues and we have an idea of what its margins are. Right now, I've just got no idea. So positives, it's fully funded. First gas is coming. Everything is in place. It's saying declining UK continental shelf gas production will lead to a lack of gas in the UK market and rising prices. We are deeply skeptical, and it has exploration potential. Of course, it could find an enormous new gas field and the shares could go through the roof. Negatives, it's gas. Whatever it says about it being a transition fuel, it's not. It's a fossil fuel. Anyway, Peel Hunt, valued at 41p compared to its current price of 16.5. Who knows? These broker valuations, you don't know whether they've been paid for by the company, and companies generally trade at quite a large discount to them. So there probably is upside here. I mean, frankly, I own this and have made a decent profit on it. And the reason for looking at it was I wanted to know whether it was undervalued or not, and I should buy some more. And the bottom line is I couldn't really work it out, so I haven't. And the obvious other negative is output will peak in 2024 without further discoveries. So, Richard, what are your thoughts?
That's an interesting presentation, Keith. I think it's fishing, apart from off Shetland, which you didn't go into the details of off Shetland, if you know what I mean. But it's sort of fishing in waters that have mostly been well explored, and it will only find small resources in the North Sea, won't it, off the east coast of the UK. So it's unlikely to find a large resource. It might find a number of smaller resources dotted around the place, but it's it's a bit of a needle in a haystack where the identification of small pockets of gas that have yet to be discovered. I was interested with the concept of the gas price rising or not rising with the oil price, because of course they're not substitutes, are they? So if the oil price goes up to $150 a barrel, for sake of argument, there's no particular reason, I think, why gas should follow it, because gas doesn't substitute for oil in any major way. Maybe a
Well,
little bit if you've got oil-fired power stations who get taken offline and gas replaces it, but you'd already have to have that there. So I don't see a big driver for the gas price to increase. Does the fact that Biden is banning gas flaring in the shale fields of the US, does that mean there's going to be more gas on the market?
no, well, it might do, but actually it's more likely that will raise the costs of shale drilling and actually suppress supply and raise prices.
So they're not likely to turn it to liquefy it and export it.
Well, they will have to, but that means that adds costs, and it means that it will slow them down because they have to put facilities in place to deal with the gas before they can build the well. That adds costs.
But it puts more gas onto the global market.
Yes, eventually it would. Yeah.
Yeah.
The other thing about the assets west of Shetland, they've got lots of exploration assets, but until they've found anything, I just don't really want to talk about them. And the one thing I would say about the southern North Sea is that because it has been picked over for very long periods of times, there is a lot of technical work on the topography of the field, which they can use. So the chance of actually finding small fields there is pretty good, I'd say, but they're going to be small.
Yeah. Well, it's interesting, Keith. And so is your plan to continue to hold these shares, do you think?
I think it is. I think, there should be some re-rating when revenues come in. And, it's a small part of my portfolio. And, as economic growth picks up, maybe electricity demand will pick up and electricity prices will rise, leading to higher demand. But, at the same time, I think renewable energy will probably limit any rises and may well suppress them. So, we need gas. And but I'm skeptical that we'll see a sustained rise in the price. So I'm holding on. And if the share price hits my target of 20p, I'll probably look to close them. So I wouldn't, the bottom line is it's very difficult to value. And I think I can't see a really big upside case for this. But at the same time, I can't really see a big downside case for this either. That they've got, first revenues coming on and so anyway.
Well, it's very interesting, Keith. Thank you for the presentation and the effort you put into preparing it. And I hope our viewers have found it interesting.
Great. Well, I'm sorry to our viewers. We haven't been able to come to a firm conclusion about this. But anyway, for information purposes only. So I hope you'll press like and subscribe to the channel. And in the meantime, it is goodbye from Richard Wheater.
Goodbye. It's goodbye from Keith Jordan.
Goodbye.
Goodbye. Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.